Every single day, millions of people sit down at their screens, charts open, coffee in hand, convinced that today is the day they finally beat the market. And every single day, the algorithms are already 3 steps ahead. The numbers are brutal. Studies show that over 90% of retail traders lose money. Not because they are unintelligent, not because they don't work hard enough, but because they are fighting a battle they don't even know the rules of. Today, we pull back the curtain. Let's start with something simple. Speed. When you see a price on your screen and decide to click buy, what you don't realize is that by the time your finger reaches the mouse, an algorithm has already executed thousands of trades. High-frequency trading systems operate in microseconds. That's 1/1,000,000th of a second. Your human brain processes a visual signal in roughly 150 milliseconds. That's 150,000 times slower. Firms like Virtu Financial and Citadel have spent billions, not on analysts or traders, but on being physically closer to stock exchanges. Their servers sit inside the exchange building itself, shaving microseconds off every trade. This isn't trading anymore. This is a technological arms race. And retail traders are showing up with a knife to a missile fight. Speed is only half the problem. The other half is data. While you're reading a news headline about an oil company, a quant fund's algorithm has already analyzed 47 satellite images of oil tanker movements, processed 2.3 million social media posts about energy prices, and cross-referenced shipping data from 180 ports worldwide. This is called alternative data, and the top hedge funds spend hundreds of millions every year acquiring it. Renaissance Technologies, arguably the most successful trading firm in history, reportedly achieved average annual returns of 66% for over 2 decades. Not by reading charts, but by discovering statistical patterns in data that no human brain could detect. Their medallion fund doesn't employ traders. It employs mathematicians, physicists, and cryptographers. The market to them is not a financial instrument. It's a code to be broken. But here's what most people miss. The biggest enemy isn't the algorithm outside. It's the algorithm inside your own head. Human brains are wired with cognitive biases that are catastrophic in financial markets. Loss aversion. We feel the pain of losing $1,000 twice as intensely as the pleasure of gaining $1,000. Confirmation bias. We seek information that validates what we already believe. Recency bias. We assume recent trends will continue forever. Algorithms have none of these. A machine doesn't panic when a position goes red. It doesn't get overconfident after a winning streak. It doesn't hold a losing trade too long because it's emotionally attached to being right. Researchers found that professional traders with damage to the emotional centers of their brains actually outperformed normal traders. Not because emotion is weakness, but because in financial markets, emotion is noise.